Okay, we're going to continue with Chapter 7, Cash and Receivables, Part B in this lecture. And to start out with, we'll talk about current receivables. And for accounts receivable, primarily what we're going to be talking about, they will result from the sale of goods or services. And the key phrase that you'll see in any transaction is the phrase on account. So if you have a sale of goods or services on account, you know you're going to be dealing with accounts receivable. It will often be referred to also as trade receivables. The opposite side of that coin is your non-trade receivables, and can include things that we won't deal a whole lot with, but will be items such as tax refund claims or interest receivable and loans by the company to other entities. When a receivable is accompanied by a formal promissory note, it will be referred to as a note receivable, and that will be part of the lecture later on in this Part B. To start off with, we'll talk a little bit about accounts receivable. And accounts receivable are informal credit arrangements, and they will be supported by an invoice. And normally they'll be due anywhere from 30 to 60 days after the sale has been completed. They will always be classified as current assets. Now, accounts receivable, that's created when a seller recognizes revenue associated with a credit sale as opposed to a cash sale. And for most products and services, the performance obligation will be satisfied at the point of delivery of the product or service. So whenever the seller transfers the product or performs the service for the customer, then the performance obligation will be deemed to be satisfied. The next section is initial valuation of accounts receivable. And because there is because the difference between the future value and present values of accounts receivable is immaterial, GAAP or FASB allows us to exclude accounts receivable from the general rule that receivables have to be recorded at present value. When we deal with receivables, primarily notes receivable later on in this chapter, then we will have to use the time value of money concept. So for accounts receivable, they are initially valued at the exchange price that is agreed upon between the buyer and the seller. Now, sometimes companies that are selling items will offer trade discounts to customers, which is usually a percentage off of the list price. And these trade discounts are a way to lower prices to perhaps good customers or large purchasing customers without publishing a new catalog. And that lets you keep confidential the prices that you're charging to those customers from your competitors. The trade discounts will always allow a customer to pay an amount that is below the list price. Another form of discount is cash discounts. Sometimes they're called sales discounts. And this will be a reduction not in the selling price, but in the amount that the credit customer pays you, the business, the seller, if that payment is within a specified period of time. And the incentive here is to entice your customers to pay quickly. Some common terminology you'll see here in the next paragraph. You'll see 2/10, N/30, which means if you pay within 10 days, you get to take 2% off the invoice. If you don't pay within 10 days, then you have to pay the full amount within 30 days. Now, there's two ways that we can record cash discounts, and those two ways are the gross method and the net method. And we have an example in illustration 7.3. The gross method will be down the left-hand side. The net method will be down the right-hand side. With both methods, the revenue ends up being reduced by the sales discounts that are actually taken. And we'll see that in both cases, and then we'll have a comparison of the two. Our company is the Hawthorne Manufacturing Company, and they offer credit to customers, and a 2% cash discount is offered if the sales price is paid within 10 days. Any amounts not paid within that 10-day period are due within 30 days of the date of the invoice. The repayment terms are stated as 2% within 10 days or the net full amount within 30. October 5th, they sold merchandise at a price of $20,000. It tells us that the customer paid $13,720, which was the amount less a discount, which the full amount was $14,000, and 2% of that, or $280, was taken off to get to the $13,720 paid by the customer. On October 14th, which is after the discount period, then the remaining balance of, the 2% discount was taken on October 14th. The remaining balance of $6,000 was paid on November 4th. Now, the appropriate journal entries for this is shown. We have the gross method on the left-hand side. We see the transaction date, October 5th, 2016. The credit sale is recorded by debiting accounts receivable, which is an asset account on the balance sheet, and crediting sales revenue, which is a revenue account on the income statement, for $20,000. October 14th, when the customer paid within the discount period, 2% was taken off of the amount paid. $14,000 was the credit for the portion of the $20,000 that is getting the 2% discount. 2% of $14,000 is your $280 that is debited to sales discounts. Sales discounts is a contra revenue account on the income statement. It will be placed right below your sales revenue account on the income statement. Cash is debited for $13,720, the actual amount of cash received from the customer, and the customer's accounts receivable account is credited for the full $14,000. On November 4th, which is after the discount period of 10 days, the full remaining balance on accounts receivable is paid at $6,000 by debiting cash and crediting accounts receivable. At this point, the accounts receivable balance is zeroed out. Now, the difference with the net method is that the entire discount is taken up front, assuming that the customer should and would take that discount. So we take 2% off of the full $20,000 and book that amount, which is $400 less. We debit $19,600 to accounts receivable and credit $19,600 to sales revenue. Same accounts as we had in the gross method, just a different amount. On October 14th, we see the payment within the discount period, and it's the same amount of cash that was paid under the gross method, $13,720, but under the net method, we simply credit accounts receivable for that same amount because all of the discount was taken out in the initial entry on the 5th of October. So we credit accounts receivable $13,720. After the discount period has expired, the final payment is made on November 4th, and you see the full $6,000 cash payment is paid, and accounts receivable will be zeroed out at $5,880 credit, but the difference between what was sitting left over in the balance of accounts receivable versus the cash payment of $6,000 is $120, and that's recorded as a credit on the income statement to interest revenue, and that's the amount of discount that was forfeited by the customer for not paying within the discount period. Again, some of the things that I've already said I've highlighted here in the paragraph below that illustration. Using the gross method, we initially record the revenue at the full $20,000 price. 2% of the $14,000 that was credited to the account on the October 14th payment, that $280 discount is recorded as a debit to a sales discount account, which is, as it mentions there, a contra account to sales revenue. It'll be right below it, and its normal balance will be a debit balance. Sales revenue's normal balance is a credit balance. So being a contra, it has the opposite side balance. Under the net, in the next paragraph, under the net method, we recorded the revenue and related accounts receivable at the agreed upon price, less the 2% discount applied to the entire price, because under the net method, you're under the assumption that the customer is going to take all the discount. Well, in this case, they didn't. If the customer loses a discount by failing to pay within the discount period, then that discount not taken is recorded as interest revenue. In our case, it was $120, which was the $6,000 final payment multiplied by 2%, which gave you $120. On page 368 here on the e-edition, we see the comparison of the two methods, and you see the total revenue is the same, $19,720 for both methods. So your total revenue will not be any different whether you record it under the gross method versus the net method. The difference will be in your sales revenue. It will be higher under the gross method, $19,720 versus $19,600. You'll see that if they don't pay within the discount period under the net method, that you will have interest revenue, but you won't have that under the gross method. Now, although the discount rate was stated at 2%, the effective rate for this is really 37.23%. Let's go through the math on how that's calculated. In order for a customer to save $2, the buyer or the customer must pay $98 20 days earlier than otherwise due, otherwise on the 10th day. So they're paying $98 early within the 10-day period to save $2. So when you take $2 and divide it by $98, you get 2.04%, and that is for a 20-day period. Now we convert this 20-day period with the following algorithm here by taking 2.04% times 365 days in a year over 20 days for our 20-day period, and that equals an annual effective rate of 37.23%. So as it says right below that algorithm, understandably, most buyers will try to take the discount if all possible. In another way of looking at this, I put a note out to the right of this. If you don't take that discount and leave your money in the bank and pay at the end of the month or the 30-day period, you would need to earn effectively 37.23% from the bank in interest in order to equal the amount of the discount loss. So there, that shows you that you cannot beat the discount. You need to take the discount when they're offered. And as you see here, this final point in this section, from a practical standpoint, the effect on the financial statements of the difference between the two methods usually is immaterial. As was shown above, comparing the two methods, the total revenue is the same. It's just a matter of how you're classifying it, whether it's going to be sales revenue or interest revenue. Now we have some subsequent valuations that we'll have to deal with for accounts receivable. And the two situations that we will encounter is a customer could return the product. That would be the first situation. The second situation would be that the customer could default and not pay the agreed upon sales price. So let's deal with the first situation, sales returns. When merchandise is returned for a refund or for credit to be applied to other purchases, that's called a sales return. Now, sellers typically account for these returns as they occur. And then at the end of the accounting period, they'll make an adjusting entry for any remaining returns that they expect to occur. And then this is the approach we're going to demonstrate first. So to account for returns, we have to have a contra revenue account on the income statement called sales returns. And that's the account that we're going to credit, or actually debit, when we have to credit cash or accounts receivable for the customer. So the sales returns account is a contra revenue account, and it will have a debit balance on the income statement. It'll be right below your sales revenues. It's contra revenue account. Let's look at illustration 7-4, and we'll see how we explain the use of this contra revenue account, sales returns. On the left-hand side, it's going to be cash sales. On the right-hand side of the illustration, we'll be doing with credit sales, so we'll have accounts receivable to deal with. During 2016, it's the first year of operations for Hawthorne Manufacturing. They sold merchandise for $2 million. Merchandise cost Hawthorne 60% of the selling price, or $1.2 million. Their experience indicates that 10% of all sales will be returned. So 10% of $2 million is $200,000. That's what they expect to experience in the amount of returns. So we're also told that customers returned $130,000 of sales during 2016, that first year of operations. And we're also told that they use a perpetual inventory system. So that means every time there's a sale, we will update inventory with an appropriate journal entry. So our first transaction, sales of $2 million for 2016, and the cost of those goods, 60%, is $1.2 million. We'll debit cash and credit sales revenue on the left-hand side for cash sales here for $2 million. The resulting cost of those sales, or the reduction in inventory, will be $1.2 million debited to cost of goods sold. That's on the income statement as an expense, and a credit to the inventory account for the same amount, and that's on the balance sheet. The next transaction description is the sales returns of $130,000 that occurred during 2016. The cost of those sales returns would again be 60%, or $78,000. So that would be our inventory amount that got returned. So our two transactions will debit the contra revenue account, sales returns, for $130,000. That's on the income statement. And we'll credit cash. We had to return cash to our customers for the returned merchandise. And that credit to cash is $130,000. When we put the inventory back on our shelves, we had to debit the inventory account for 60% of that $130,000, or $78,000. And we credited our cost of goods sold on the income statement for $78,000 as well. At the end of 2016, we had to book an additional, or accrue an additional, $70,000 based on our industry experience, that 10% of all sales will be returned. We've already accounted for $130,000 in returns, but Our industry experience tells us that we'll have 200,000 in returns related to all of these cash sales in 2016. So at the end of 2016, we have to accrue an additional $70,000 for sales returns that are expected to occur. And we will debit the sales returns contra revenue account on the income statement and credit a liability account, refund liability, because we expect that customers will be bringing in. Excuse me just one moment, I have to take this phone call. Sorry for that interruption. Continuing on here, we got the $70,000 that we had to accrue at the end of 2016. We did that entry to the contra revenue account, sales returns, debit 70,000, and a credit to refund liability on the balance sheet, because we expect that we're going to owe that amount of refunds based on our industry experience. We'll also make an estimate for inventory returns. This will be on the balance sheet. Debit to $42,000 and a credit to cost of goods sold. Now in 2017, when if those $70,000 in returns do occur, here's the entries that we'll make. We'll zero out our refund liability by debiting it $70,000, and we'll actually give our customers back in cash $70,000. We'll then debit our actual inventory account, $42,000 for the cost of those, and credit our inventory estimated returns, which will zero that account out. Now on the accounts receivable side, we have in the first transaction, same dollar amounts. The only difference is it's not cash. We're dealing with accounts receivable. So that's your initial debit for $2 million to accounts receivable. When we have the actual returns of $130,000, you see that we just credit accounts receivable rather than cash, because the customers didn't initially pay us cash. They were sales on credit. That's the only difference you'll see in the second part of that transaction for the $130,000 returns. Now, in the third transaction, and you'll see it because it's highlighted in color, that's basically what's different, the red and the blue, where we had to accrue $70,000 in returns at the end of 2016. Our credit, when we're dealing with accounts receivable, goes to a contra asset account, allowance for sales returns. and that will be right below our accounts receivable to give us our net receivable. So the cost of those estimated returns based on our industry experience is 60% or $42,000. So we'll debit inventory estimated returns and credit cost of goods sold for $42,000. Our final entry then in 2017, when those actual returns materialize, we will debit the allowance account for $70,000, which will zero it out from above the entry we made at the end of 2016. We will officially credit the customer's accounts receivable for $70,000 and do our cost at 60% entry by putting that inventory back on our shelves at $42,000 and then crediting the estimated inventory returns, which would zero that out from the entry that we made at the end of 2016. You'll see that those two colored accounts are in the same color actually down in the paragraph directly below that illustration 7.4. The refund liability account, that is for the cash paying customers. If the customers are paying on a cash basis, once the returns are actually made, then we would give that cash back to the customers at that point in the future when they are made, which in our illustration was 2017. The allowance account, which is the bluish colored, you see that that is a contra asset account to accounts receivable. Now reduce the balance of accounts receivable for the estimated returns. It also mentions down here below at the actually on the e-edition, it's on page 370, that by using a perpetual inventory system that will record the increases and decreases in the inventory account as they occur. That's the opposite of the periodic system, and we'll get to that when we get to the inventory chapters. But you should have already had that in your principles courses, but perpetual means you update inventory after every single transaction. If there's any damaged or defective merchandise returned by a customer, we, the seller, then will have to write that inventory down to an amount that we expect that we could receive for it if we could sell it or dispose of it. If we don't think that we can get anything out of it, then we need to write it down to zero. Now, what happens if the estimate of the future returns, those returns that were going to occur in 2017, turn out to be more or less than that $70,000 estimate? Well, we'll simply just adjust our accounts to reflect that change in the estimated returns. So suppose that our illustration that the 2017 returns are $60,000 instead of what we estimated at $70,000. Well, we simply need to make a $10,000 adjustment to our allowance account and our sales returns. So by debiting the allowance account for sales returns, we will reduce its balance. And by crediting the sales returns, which is a contra revenue account, we would reduce its balance as well. And that will actually give us more revenue since we're crediting the account on the income statement, the sales returns account. Our cost of goods sold will reflect those that there was actually more sales by debiting it $60,000 or $6,000. I'm sorry, 60% of $10,000, and by crediting inventory estimated returns because we are not expecting to get as many returns as we originally thought. So that would take care of any change in our future estimates. Now, how do companies estimate returns? Well, as we saw before, they were relying on industry experience. That would, be similar to, your past history, taking into any changes that might affect your future experience. We see in illustration 7-5 a policy for ABX Corporation that discusses their policy on returns and how that will affect their revenue recognition and their accounts receivable. Some industries, the returns are typically very small and infrequent. Now, for companies that have small and infrequent returns, they can just generally record them as they occur, if the effect on their income and asset valuations is immaterial. Now, we may have a situation where we have some uncollectible accounts receivable. And in that situation, we're going to have an account called bad debt expense. And you're always going to have this account if you grant credit to customers. I've never experienced where all credit customers paid 100% in any business I've been associated with. So what we'll have here is when you have, even at the end of a period, even if your customers haven't proven yet that their accounts are going to be uncollectible, we should go ahead and record an estimated expense so that we're matching the bad debt expense with the sales revenue in the same accounting period. What we'll end up with on the balance sheet is a net realizable value of those credit sales by taking the accounts receivable and subtracting that contra asset account, the allowance for doubtful accounts. So an adjusting entry that we'll make will be a debit to bad debt expense, and we'll reduce our accounts receivable indirectly by crediting that contra account to our accounts receivable, the allowance for uncollectible accounts or allowance for doubtful accounts. You can use either title. This approach is known as the allowance method, and companies will report that allowance parenthetically or alongside the accounts receivable title, as you'll see in illustration 7.6 for Johnson & Johnson. Now, this allowance method applies the matching principle in accounting, because what we're doing is we're making an entry to allow for uncollectible accounts and reporting a bad debt expense so that it's matched up in the same accounting period as our credit sales that are occurring in the income statement under sales revenue. Sometimes, not very often that I've seen, companies will simply show the net balance in the balance sheet and then describe an uncollectible account in their footnotes to the financial statements if it is material. But again, more often than not, we will see in any financial statements that we take a look at, or if we're working for a company, we use the allowance method. Now, there's two ways that we can come to our estimate of future bad debts. There's the income statement approach and the balance sheet approach. Now, our data that we're going to work with here is given in illustration 7-7 for the Hawthorne Manufacturing Company, and they sell their products with 30 days credit to customers. During the first year of operations, their sales on credit was $1.2 million. They collected $895,000. So their accounts receivable at the end of the year was $305,000. They anticipate that 2% of all credit sales will be ultimately uncollectible. So our first approach is the income statement approach, and it's probably the easier of the two, because you simply just take a percentage times your sales, and that's your journal entry amount. So we will estimate the bad debts expense under the income statement approach based on each period's net credit sales. And we'll determine that percentage that we're going to use based on recent history within the company. That recent history being how many sales in the past few years have gone uncollectible and resulted in bad debt expense. So our adjusting journal entry in this case for Hawthorne, illustrated in 7-7, we would take 2% times 1.2 million sales on credit, and that will give us $24,000. We will debit bad debt expense, which is on the income statement, and we'll credit allowance for uncollectible accounts, which is a contra asset account on the balance sheet. Our balance sheet will look as follows. We'd have $305,000 in our accounts receivable account. Underneath that, we'd have our contra asset account, the allowance account, with $24,000, and that is a credit balance. And our net debit balance then for receivables would be $281,000. And this income statement approach focuses on the current year's credit sales. Our alternative to the income statement approach is a focus on the balance sheet amounts, and that's the balance sheet approach. And we will determine bad debt expense by estimating the net realizable value of accounts receivable. And we'll generally we will have to use an aging report of accounts receivable to help us accomplish this. And what we want to do is we want to adjust our allowance account to reflect the desired balance that we need based on that analysis of our aged accounts receivable schedule. So how we will approach this is with illustration 7-7A, and we will take our various columns of accounts receivable. You'll see the customer names down the left-hand side, and then how long their amounts that they owe us are past due. The first column being 0 to 60 days, the second one being 61 to 90 days, and so forth on out to over 120 days. As we work to the left, we see the total amount that each customer owes us, and that corresponds to what we have in accounts receivable for $305,000. Then we see the subtotals going across to the right that break down that $305,000. And those subtotals then in those number of days columns is what we have down at the bottom of this schedule, and that's where we apply our percentages that we have determined based on past experience. Now, within 0 to 60 days, we expect 5% of those, the amounts in that column, to go uncollectible. So $220,000 in that column times 5% is $11,000 for that category. Now, as customers amounts owed to us extend on into the future as unpaid, the longer they are out there as unpaid, the higher the percentage is that typically we won't get paid. So as the number of days increases, so will our estimated percentage of uncollectability. And when we do our multiplication out here, we get an estimated amount in our allowance count of $25,500. And you'll see in this next paragraph down here that the longer, what I already said, the longer an account has been outstanding, the more likely it will prove uncollectible. And that's the reasoning behind the percentages increasing as time passes and we haven't received payment. So for the first year of operations, Hawthorne will need to have an allowance account balance of $25,500. Since the first year of operations it would start out at 0, that would simply be our debit and credit entries. Debit being to bad debt expense, $25,500, and a credit to the allowance for uncollectible accounts, $25,500. Now, this next paragraph here on page 373 tells us, well, let's suppose this wasn't the first year of operations. And this is what is different with the allowance method you have to pay attention to a balance that's already in the allowance account if it's any year other than your first year. So what they're going to tell us here is, let's assume that prior to making an adjusting entry, that the allowance account already has a credit balance of $4,000. If that were the case, then we would only make our journal entry for $21,500 because our estimated amount up in our illustration was $25,500. And you see that here in this T account, first T account for the allowance account, where it had an existing $4,000 balance, and we made our adjusting entry at $21,500 to get it up to the $25,500. Now, some companies will use both approaches for estimating bad debts. Hawthorne could decide to accrue the bad debts on a monthly basis using the income statement approach, and then employ the balance sheet approach at the end of the year. So here are the T accounts that reflect using the monthly amount, the 2% of the 1.2 million sales that we had up here above. The 1.2 million sales, 2% would be $24,000. So that reflects it going on a monthly basis. And we see our T account here that reflects that $24,000 in the allowance account. Now we need to get that up to $25,500. So at the end of the year, we would simply make an adjusting entry for the $1,500 by crediting it and debiting bad debt expense for that amount to get our allowance account up to the $25,500 amount. And we see that entry right here, bad debt expense, debit for $1,500, and a credit to the allowance account on the balance sheet for $1,500 as well. And that entry allows our accounts to reflect the following amounts on the balance sheet. The 2016 balance sheet would reflect $305,000 in accounts receivable. Our allowance or contra account would reflect a credit balance of $25,500, and our net accounts receivable would be $279,500. What happens when accounts are deemed uncollectible? Well, we have to write those off. And how we do that, under using the allowance method, the write-off is recorded as a debit to the allowance account, which will actually reduce its balance, and a credit to accounts receivable, which will reduce its balance as well. And that's the entry that we make when we have a specific customer that we're saying they're not going to pay us and we need to write off their account. So here is the entry or the transaction description for actual bad debts in 2017 for $25,000. We see we debit the allowance account for $25,000 and we credit accounts receivable $25,000. Now that $25,000 credit would take it out of the specific customer's account that we deem to be uncollectible. And we see that in a T account form here for the allowance account. Now, the write-off account, to write off the accounts receivable, that's going to reduce both, as I said before, accounts receivable and the allowance account. But you see, after this direct write-off, we had $25,500 in our allowance account. Now the ending balance is $500 after making that debit to the allowance account. Our $25,500 credit is reflected in the balance sheet illustration up here at the top of page 374. The net realizable value is still unaffected at $279,500 from this write-off of an account that was deemed uncollectible. So it's same as the balance sheet amount that was shown up at the end of 2016. So if you have any changes in estimates, you make those in the future whenever you need to revise those estimates. What happens if you have a customer say, well, I want to make good on my account even though you've written it off, in order to try to keep a good name? Some customers will do that even after you've written off their account. And what that is called is a recovery of accounts receivable that was previously written off. Basically what you have to do is a two-step process. You reinstate the receivable and then you record the cash payment. So let's assume here that we had $1,200 that was previously written off, and that the customer came to us and said, well, I want to make good on my account. I want to go ahead and pay you even though you've written it off. So to reinstate the receivable, we would debit the accounts receivable account for $1,200 and credit the allowance account, because that's what the entry we made in reverse when we did a write-off, as it was explained up above. So we would go ahead and credit the allowance account for $1,200 and debit the accounts receivable to put it back into accounts receivable so the customer could pay us. Then the customer pays us the cash, debit cash, $1,200, and credit accounts receivable, and that takes it back off of the accounts receivable with the credit entry there. And that will allow the reinstatement of the receivable and the recording of the cash collection. The direct write-off of uncollectible accounts, if they're not anticipated, if uncollectible accounts are not anticipated, or they're immaterial, then we probably would not have to necessitate an account for allowance for uncollectible accounts. If you had such a situation where you did not have to record for an allowance method, and you could use the direct write-off method, then the entry we see here for a $750 uncollectible account that was determined uncollectible would be simply to debit bad debt expense and credit accounts receivable for the $750. Again, that's known as the direct write-off method. Now, the direct write-off method is not permitted by GAAP except in limited circumstances. The allowance method is the method you must use if you have a material amount of receivables that you estimate will not be collected. However, for federal income tax purposes, you can only use on your income tax return the direct write-off method. They are not going to allow you, the federal government, the IRS, is not going to allow you to estimate your write-offs for a bigger tax deduction. So you can only use the actual write-offs under the direct write-off method for income tax purposes. There are some additional exercises there. I think I'm going to conclude this lecture and pick up with the notes receivable section in another lecture part, and that will be also posted to the middle page.